Thank you very much. Thanks, guys. We're now in the slot and after afternoon tea. People are taking some sugar in, and we'll see how this goes. So I'm Stuart Stoyan, ex-Money Place and FinTech Australia, now helping out the beautiful people at EY on all things FinTech and supporting the team there. We've got a fantastic panel lined up for today. I'll let the guys give a quick introduction to themselves now, and then we're just going to dive straight into it. So to my left is Leanne.
Thank you. Hello, everybody. Leanne Jones, CEO of Nemo Industries. We are a digital lending platform, essentially a SaaS platform that we on-sell to lenders, and at the end of the day, helping customers to have a frictionless lending experience.
Now we have Lisa.
Hi, everyone. I'm Lisa Fraser. I'm Chief Operating Officer at Judo Bank. We're a small, medium-sized business lender, so a specialised lender. And my role runs product, digital, data, tech, InfoSec and Ops.
And lastly, we have Stephen.
Hi everybody, I'm Stephen Duke. I'm Global Head of Marketing at Wayflyer. We're one of the world's largest revenue-based financing providers. So we provide funding primarily to B2B businesses and primarily in the e-commerce space.
Fantastic. All right, we're going to get into it. We're going to try and keep this entertaining and free-flowing, and we'll have some fun with it ourselves. So I've been on lending panels for Intersekt since Intersekt started, and we're always back and we're always here. We are the pillar of the fintech industry. But so my question to the guys now, first and all, is what role have fintechs had, and specifically lending fintechs had, just in shaping overall lending today? Happy to start with anybody who wants to dive in.
I can.
Go for it.
Thank you. I think we play a really pivotal role in that we bring to the fore things that we perhaps didn't think were possible. Particularly, I think in the morning address we heard things around the fax machine. We used to have things like the BlackBerry, and I think we're moving into a generation where there are things that we imagined, and fintech companies are really putting them on the floor. Things like having frictionless lending, a complete digital lending experience. I think a couple of weeks ago, I was in another conference and they were talking about the battlefield, the time to yes, and that used to be on everyone's lips. I'd like to say, and I think the fintechs are really pushing the boundaries, and it's more than just time to yes now, it's about time to money in bank, where I think it's at the moment. So we're definitely pushing the boundaries is what I think.
Lisa, Stephen, yeah?
Yeah. So I would agree with Leanne. We're also, I think, really important in filling a void in the market. So Judo started because small and medium-sized businesses couldn't get capital, and today can't get capital from the major banks. It's just an unloved segment of the market, and yet it drives the economy. So I think there's a role for us to play, not on only making it lending frictionless, transparent, so customers, whether business customers or consumer customers, actually understand what they're doing, because there's a lot of jargon in financial services. But we are here to also meet unmet needs.
And Stephen, you're filling a void within a void, if you want to expand on that.
Yeah, I was actually just going to expand on that exact point. So I think the role that we play as a fintech is in filling a void for businesses that didn't even exist, 5 or 6 years ago. So these very new businesses who have a very specific set of problems, which traditional banks probably don't cater for very well. And fintechs are really good at doing that. They're really good at picking up on that niche, a niche in a void, whatever you want to call it, and creating a really good specific solution for that problem.
Absolutely. Now, you've brought up traditional banks. Absolutely, fintech lenders are filling in new niches, serving new customers. But arguably, I'd posit we're also doing it much more efficiently and much better operationally. What are your thoughts there? And maybe just start with you, Lynn, given that you support a bunch of lenders doing this.
100%. I think we're niche, we're specialists. That enables us to be nimble. I don't really want to say the word agile, but dare I say, we're agile, we can move really quickly. It also means then we can bring things to market very, very, very quickly. I met with a lender a week or two ago, a large lender who was sharing with me that they have a team of about 50 developers and have quite a large spend. They must have quite deep pockets. I mean, that's not the case with fintechs. We're back to Lisa's point and the other point that was made, we're definitely filling a gap in the market to bring things to market much quicker.
And Stephen, how do you think about continuous improvement and sort of continually refining the proposition and the service that you guys are delivering?
Yeah, well, I mean, I think a lot of that is just baked into the culture of working at a startup or an early stage company. It's like we probably don't even think about it. And I'd say a lot of the people in this room, if they work for a similar early stage company, it's the same. And I think the reason is because if you don't, like, it's all we do, so we die. So it's like either you figure out a solution, you continuously improve, and you get really, really good at it for your customers. Like, there's no other part of the business for us to rely on that's going to come and save us. It's like we either figure out how we do this really, really well, or that's it. There's nothing else. And so I think that kind of constant threat of death is actually a pretty good motivator.
And to sort of close this thread out with Lisa, a lot of the judo team are ex-NAB as well as other banks. What is it that makes judo so successful that can be achieved as judo that couldn't necessarily be achieved within the great ivory towers of a big four bank? Recognising that Lisa's also part of a listed company as well.
Yeah, so we listed in November, so, and we just did results. But so look, I think there are a few things. It's quite similar to, in some ways, what Stephen said. The advantages of startups, and I've spent most of my career in San Francisco up until last year, is a single purpose mission. So everybody gets behind that. When you compare to a major institution like a big bank, there is so much fragmentation, and any time an executive change, the priorities change every couple of years. And so that's a disadvantage for a major bank. And then I would say part of the other success story for judo is also our culture. So we talk about, as a startup company, we had no legacy technology, we had no legacy processes, no spaghetti, which is all true, but we also didn't have a culture. And when you think about what goes wrong in financial services, and the culture and the bureaucracy, the frozen middle of a company, in big institutions, we don't have that. And I think that is part of a combination of our competitive advantage.
Now, we talked about time to yes. What is it exactly it is that fintechs have done that have improved customer outcomes? Because time to yes is one component, but there's a bunch of other things that you guys are achieving too.
I'd say in terms of shifting the dial, we're moving from time to yes to time to money in the bank. And that's what Nemo's been able to prove with complex loans, home loans. We've tackled the home loan market. And with live customers, we're able to get money in the bank, get a customer from inquiry all the way to money in the bank in the same day. I think that's a game changer. It gives the buyer, the customer, confidence. It's really been obviously beneficial to the lender. It takes that customer off the market. Improves efficiencies, allows them through those efficiencies to redeploy resources to have other enablers in their business.
Either you guys, yeah, Lisa, jump in.
Yeah, I'll add. So a couple of things we do is we believe in relationship-led banking. So our bankers are actually out meeting customers all the time. It's part of the first step in actually making a credit assessment. But those bankers are also empowered to make a lending decision. So they have a lending authority, we call it the Judo Lending Authority, and they're empowered in market with, and if they need to bounce it off credit, the credit managers are also in market with them. There's no going to a head office, there's no waiting 6 to 8 weeks for a model and a rules-based decision. And that is really important because when a banker can turn up in front of a small, medium business and say, here's what we think we can do with a term sheet, changes the game.
Stephen, just your perspectives on that?
Yeah, I think I don't think it's too complex. I think we could probably all list out the things that customers care about, right? It's speed, it's simplicity of the process. Nobody wants to spend days or weeks of their life filling out long application forms. It's price, and I think fintechs have not all the time, and a lot of time they actually start off as more expensive options, but over time are getting much more affordable as well. It's quality of service. So how well can you actually deal with your customers, and what support do you provide to them? And I think the last one is where can you go above and beyond? Like outside of, say, the core product that you're actually providing, what other services can you provide to solve some of the other problems that your customers care about? And so it's not it's no mystery, right? We all probably could have said the main things that customers care about, and I just think fintechs have largely done a really good job at executing on those.
Is that also the singular focus that fintechs have in terms of it helps you to be able to then focus in on customer needs as well? Whereas, I think, at least to your point, it's very hard navigating around a big bank. It's more about the navigation than the outcome.
Yeah, but I would say as a startup or early stage company, you actually have to focus on your capital and capital raising. So it doesn't matter how singular focused you are on meeting customer needs, as Stephen said. If you don't have a capital runway, you can't help a single customer. So you actually have to have a mix of capabilities in your team that can, in our case, raise money and lend money, and they're two different skill sets.
And does that also then move into partnering as well, I guess, in terms of, I mean, you sort of touched on this, Stephen, in terms of meeting a broader set of needs, and how do you guys each sort of think about partnering?
I can probably share a thought there, powering partnerships, and I see that happening at the conference here today, the networking and the partnerships, and I wonder if that's part of the evolving landscape of lending. Certainly as a vendor, we're all about partnerships because we are long and deep and specialists in digital lending. Perhaps maybe not for some of the bigger lenders, but I think there's certainly a gap for perhaps tier 2, tier 3 lenders who, the commercials, they don't have the commercials to build it themselves. So I think the partnerships are very real, and I think that's in the fintech land, it's really the trend of the future in many ways.
Is Judo partnering yet officially, or is that something you guys are looking at and considering? So say there's a regional bank that doesn't have a SME capability. Is that something you guys would consider?
Well, we would never say we'd never consider all sorts of things. So we do a lot of partnerships, but we haven't yet gone that far. So we are back to simplicity and single focus. We're still mainly driving lending business, core business lending. Over the years to come, we hear of other opportunities to meet small and medium-sized business customers' needs, and partnerships will play a big role for that. We fundamentally believe it's an ecosystem, and finding the right partner is actually really an important skill set for any company, I believe, today, to actually be able to not just vet technology or product, but the people in the organisation too, for success.
It also gets to, I guess, who you platform with. So from your perspective, Stephen, who do you guys partner with, and what does that look like in terms of, say, platforms that you might help amplify and work with as well?
Yeah, sure. So, I mean, we partner with and use so many different companies, right? Because I was actually listening to a podcast on the flight down this morning about Amazon and AWS and Jeff Bezos' focus on, you got to just focus on what makes your beer taste better and outsource everything else, right? And the great thing is that as a fintech now, there's so many other great fintech solutions out there so that allow you to really only focus on the parts that you can be differentiated on. And so that's a really big focus for us. Like we partner, of course, with folks like Stripe and Shopify and all these great businesses, because that's what allows us to focus on the bits that really matter to us. Like we don't need to go out and redesign payments, right? Like that's not what's going to make a difference to our customer.
I'd agree with that, Stephen. I mean, looking at the talent in today's, festival, for example, there are so many niche fintechs providing different slices of the pie to the solution, and we've got such talent in our region, and it makes sense to partner with where the talent is and the SME is, and then focus on how you brew your own best beer.
Yeah.
So, US statistics, but back in 2010, you'd be lucky if one financial product was launched a year. Like, they were the actual statistics. And then 10 years later, it's like 15, 16 a year. I mean, and that has been, right, the ability, for organisations to partner through cloud and technology changes and the cost of computing. And that has opened up, right, the evolution of fintech. Because 15 years ago, people would have said, particularly in Silicon Valley, do we really want to go into a regulated industry? And you play that forward now, and everybody's in every regulated industry. So, but it was actually the fundamental change was the ability to use technology to enable partnerships and the lower costs to start a company.
There's also been, and we're completely off script now, so we're just winging this.
Say
now.
that's what you wanted?
No, we did say that was part of it, but now we're going different directions, which is historically it was more fintechs putting banks out of business. And it was fintechs versus banks or versus traditional sort of lenders. Now it's much more collaborative and there's much more partnering. What do you think has driven that? Is that because bankers are now running fintechs and that sort of gives you back channels, or is it also that banks have just changed their mentality a little bit?
I'll start. So there was a theory, and it was largely driven out of Andreessen Horowitz, that there was one financial service app for everybody, meaning you didn't want to have different financial services coming from different apps. Like that was the premise, early fintech investing, and then that's proven not to be true, right? So once they realised that it was like we can take over every service that a major bank or incumbent bank does, that's not how consumers interacted with financial services. It broke down of the us versus them. That's what I think, anyhow.
Yeah, I also wonder, consumers are after variety. New generations are coming through. They want access quickly to a variety of options. The monolithic systems of the past, perhaps some of the bigger players, they're looking for alternative options, and that's opened up the discussion. Open banking, of course, is on everyone's lips, and I think that also opens up a conversation around different solutions and enabling people to be in control of their own financial success and goals.
I mean, I don't know that I have a good answer for this. I think it's probably a pretty
in that
hard
case, we'll
answer.
move on to the next.
But I do think there is, to actually use the do what makes your beer taste better analogy again, right? It's the same thing, right? So what, like, fintechs have perhaps been very good on the customer experience and the front end side, but banks still have balance sheets, right? And so that's a really forces you to have to partner with them in certain ways. And then I think it's also, we need to recognize it's so massive. When I think about trying to create that one service that does absolutely everything for every different type of customer and every different financial service, it's ridiculous. Look at the biggest fintechs in the world, the likes of Revolut coming out of Europe. They're absolutely massive, and there's still whole realms of financial services that they can't yet provide. So it's just such a mammoth task, and I think we probably underestimated how big it was at the start.
Wasn't it a former CEO of Westpac who said that we're a 200-year-old fintech? So I guess that points to, though, these large-scale financial services businesses are built over centuries, not sort of years. An area that fintech lenders do excel in is in data. Keen to get your thoughts around what is it that's helped, meaning that fintechs are able to actually sort of dominate in the data space. I guess, Stephen, particularly for you guys, because what you guys do with data is super impressive.
Yeah, so maybe let me start by giving just a quick overview of what we actually do. So we provide finance to e-commerce businesses. And so how we assess their worthiness of finance is actually by plugging in to all of their online commerce platforms. So, for example, if a business is running on Shopify, they plug in their Shopify to Wayflyer. Well, they'll also plug in their Facebook ads, their Google ads, their Google Analytics. And so what that gives us is an incredibly powerful picture of the health of their business, because that's what their business is. Their business is a Shopify store, and it can be doing hundreds of millions of dollars, but it's still all going through a Shopify store. And so we have this huge amount of data that can be incredibly predictive in terms of their future performance as well, especially now that we've worked with tens of thousands of e-commerce businesses. And so it's that type of data, which is a very different type of data to what we traditionally look at when we think about credit decisioning, that allows us to make really good underwriting decisions. So that's what we do, and kind of our USP is all around our underwriting ability, and that's what allows us to provide funding to the good customers and to provide it to them at really good rates as well.
What about SME lending? I think you guys famously make your interviewees sit a test, or was that, I remember that from a year or two ago. That could have just been PR to help sell a book.
No, actually, all bankers who apply to Judo go through a rigorous interview process, and including a credit assessment. And what you're referring to is half the bankers who apply to Judo fail in the credit assessment. So data is really important in lending. I mean, let's not get that wrong. It's also important to the regulators. So it's fundamental to how we think about the future of lending. I think it's really important to understand how data underpins a banker and customer experience, and how a banker can actually help a customer achieve whatever their ambition is. It's not good enough to turn up anymore and say, hey, hi, I'm here, which actually is a big step forward compared to the majors. The bankers actually have to add value. So the judo bankers are consulting on all sorts of things around business growth, to manage buyouts, to all sorts of different things. It's a lot of data underpinning that.
And then consumer space, we've got things like CDR happening and transactional data. What's happening there?
In many ways, I think having access to more data and CDR, data gives us choices. It gives us more choices as a consumer and more choices as a lender. And if we think about credit decisioning, we have access, through fintechs and the likes of Nemo, access to live dynamic data that's instant, that has a single data lake. The other thing I'd add to the data integrity and governance, and data is important and how we treat it, is how we, if we look at past practices where data gets lost or mismapped or it's erroneous or just goes into the ether somewhere, the new space of digital lending allows us to have more governance over that process, and enables at the end of that process the customer, the consumer, the lender to have more choices and more informed choices in particular.
Awesome. So we'll open up for a question or two from the audience in 1 second while you're thinking of those amazing questions, and we get the guy ready with the roaming mic. How do lenders now scale profitably? And maybe start with you just on this list, because you guys just came out with a result. You're 2x prospectus. You're a big lender, but still very early stage in terms of profitability. How does profitability scale?
That's my day job. So we would have said chapter 1 is start the bank, and chapter 2 is scale the bank. So we're very early, like if you think of a story. And essentially, we have a flywheel going on the business model, from the ability to lend and the quality of our credit portfolio. And now, as we're scaling and hiring more bankers and serving more customers, and then also serving new customers and existing customers, it all comes down to the unit economics, right? It's all about driven by the unit economics of a loan. So to acquire, originate, settle, and service a loan. And so my team and I are driving through all the opportunities to optimise around the unit economics of a loan, while maintaining customer NPS and employee NPS. So, a lot of people will say, and I think you asked me this too, Stuart, is it harder now than is chapter 2 going to be harder than chapter 1? Chapter 1 was like get a banking license and all the regulatory stuff and raise capital, and chapter 2 is just as hard, I think.
Can I add to that? I think Lisa's absolutely correct. There's so much to balance when you think of profitability, but the unit of economics is critical. And I know at Nemo, if we do the math and the research, an average size lender, it might cost circa $900 to originate a loan. Where their profitability might come from is deploying some new approaches and solutions like Nemo, where we can get that same loan to originate in a much quicker time, and in fact get that money in the bank the same day of inquiry. But we can do it at circa $200 to originate. So the economics on that, it's $9 million profitability piece each year.
Any thoughts, Stephen? Or we're open to the audience, and somebody can ask you a question about your amazing moustache.
Well, I actually just have one interesting point, right? Because I think there's been some talks today about, going global and internationalization. And I think the interesting lesson that we've learned is because we're focused on this, we're focused on a vertical, right? Which is only e-commerce businesses. And we get really good at building technology to be able to finance e-commerce businesses. That the way that we scale, and we scale profitably, is by being able to expand into new geographies very, very quickly. So within 2 years of us launching, we were in 12 different markets across North America, Europe, Australia, and New Zealand. And so as a fintech, a lot of your costs are fixed costs because you're employing engineers and product people to build this technology. But then once you're able to do that, by expanding your market, that's what actually helps you to scale and scale profitably, which is very different to some other businesses that are purely focused on a specific region and looking at how they can expand within that region.
You can get market share quicker, faster, broader.
Yeah, 100%, and it's surprisingly quick for us to be able to land in a new market and expand within that. But again, it's because we focus on a vertical. If we were going in and trying to target every SMB in Germany, that would be super, super hard. But because we just have this vertical, it's a bit easier.
Awesome. Let's see if we've got a question from the audience. If anybody, hey, we've got a hand at the front, third row. Wait 2 seconds, the microphone will be with you in about 4, 3, 2, 1. There
Everyone
we go.
must be coming down off their sugar high.
It's been a very pleasant crowd, I will say that.
Great conversation, guys. Thanks so much. Some really good insights there. Lisa, a quick question from you, and it's probably asking you to expand upon your thoughts with Chapter 2. Judo has, gone on quite an innovative journey over the last couple of years, and question is, you spoke around the fears of the frozen middle. How do you avoid that as the business scales? So how do you face into the challenges that big banks have around technology, around hierarchy, around bureaucracy, whilst maintaining that that real commitment to innovation and product development?
Great question. Not easy. It's a day by day sport. So Joseph Healy, our CEO and founder, would say his biggest fear is waking up and we're a mini-me bank. And that's language across all of judo, right? So we know what our fear is. We also have a challenge in that we are a regulated bank, and therefore there is bureaucracy associated with that. And our challenge is to ensure that as we approach the bureaucracy related to being regulated is as tight and as effective and as efficient. We challenge how many board meetings we have. We challenge how many papers we really need to write. What's the length of the papers? We challenge every single thing on a continuous basis, because if we don't, and as we hire people coming in fast, right, that frozen middle is definitely the risk. Our induction program is actually really important as well. So the entire company, anybody who comes into judo spends an entire week learning about the company, and I mean everything, how treasury works. So if you go to a major bank, you don't know how other parts of the bank work, but people have come into judo and why are they telling us? They're telling us everything, the whole secret sauce about the whole company. Because we believe if we share how everything works today, people at judo will find will bring new ideas to make it different and do it differently forward. So there is a lot of, now we're starting to actually things around agile blueprints and processes, right? We are trying to actually measure velocity and a whole bunch of other things we haven't done before. But again, it's with that whole concept of our culture first, doing it by judo people for judo, and avoiding bureaucracy. And fear comes with bureaucracy. So that's what we're trying to stamp out.
I love that. It's like starting as you mean to go. And I think fintechs, because we're not burdened by the legacy of the past and the cultural blueprints, we have the ability to shape things how we'd like them to be.
I know at Moneyplace the best feedback we got that we loved was somebody saying this was the best experience I've ever had from a bank. It's nothing like I've ever experienced before. It's like, hell yeah, that's because we're not a bank. One more question. Anybody? Beulah? No? Yes? Question at the front.
Interesting question, and from some of our customers, is how do new financial entrants or financial market entrants manage the trust of their customers when they're being asked to provide open banking details, provide their banking details, log into systems, and they haven't got that trust of that new brand yet? How have you dealt with that?
I can't answer that because Pete's with me. So,
so the way we talk to customers about what does it mean, trust, and what is a relationship, and pretty much everybody will say the same thing. So what they want from a bank is say what you're going to do, and do what you say. And if you do that, right, we respect and trust you. So even if we, because of a complexity of a loan, and we say, okay, we need another week, they're okay with us telling them we need another week, as long as you tell them why, and then come back, in a week and have it done. That's kind of the core of it.
I think, so the only thing I would add to that is, and we made this mistake at the start, is not trying to convince 100% of the market at the start, because there's going to be this adoption curve. And so at the start, you might get 5%, but that's all you need. And then once you have that, the next 10% will trust you, and then the next 25%. And so there's customers now who we're working with who 2 years ago thought we were too small, and we're like, oh, I don't know, guys, seems a bit risky. But now, once we're a lot bigger, they come on board. So I think you, just by focusing on the people that you can gain their trust with, is what gives you the stepping stone to the next cohort of customers.
That is super insightful. To close out with 3 more insights in 10 words or less, starting with you, Stephen. What is it that you are most excited about in the next 2 to 3 years that's coming ahead in lending tech? That's one
Way to
word.
put me on the spot on this one. I think like the flexibility around the new products. I know that's a vague answer, but it's going to.
But that's 10 words. We can take that.
I think it's about creativity, using technology, data, and digital. New things will come.
Cool.
Yeah, I agree. I can't wait to see what we have not yet imagined come to fruition. I'm excited about what open banking will bring, and what that means from an innovation perspective and the lending
Awesome.
platforms.
Thank you very much, guys. You've been very pleasant. You haven't thrown anything. That's awesome. Thank the panel. Have a great afternoon.